week's market update. Easing trade tensions boost shares, OPEC is in focus as Qatar withdraws from the oil cartel, and Theresa May's make or break week gets underway. Things may have quietened down on the corporate front as the traditional pre-Christmas lull begins, but there's plenty for investors to focus on this week. Top of the agenda at the weekend was Donald Trump's Argentinian state dinner with China's President Xi. All eyes were on the leaders of the world's two biggest economies, with low expectations for a solution to the trade wars that have been one of the dominant market stories this year. As expected, the two sides remained some way apart at the end of the evening, but enough progress was made for the two to at least call a temporary ceasefire in hostilities. The planned extension of US tariffs on Chinese exports from 10% to 25% will now not happen in the new year, but has been pushed back for 2 months. In exchange for that temporary reprieve, China has agreed to buy a range of US goods, such as soybeans, to narrow the trade gap between the two. And perhaps more importantly, it's made concessions on issues like intellectual property theft and forced technology transfers. It's also made promises about not using currency devaluation as a trade tool. Donald Trump has tweeted that China has agreed to cut tariffs on car imports from the US, although the Chinese have not confirmed this. So, there's enough for both sides to claim a victory of sorts, even if this looks a lot like the can being kicked down the road, rather than anything more substantial. After months of rising tensions, however, even this was enough to give markets a significant boost when they reopened on Monday. Shares rose sharply in Asia, and the good news flowed through into Europe, where the FTSE 100 quickly rose more than 2%. The strength of the UK market also reflected the heavy weighting of commodities-related stocks, with the price of metals jumping on hopes that an easing of tensions will help stabilise Chinese growth. Copper rose by 2%, while steel prices in China were 7% higher. London-listed Chilean copper miner Antofagasta saw its shares rise 8%. The UK market, which has a big energy component, also benefited from a sharp rise in the oil price, which bounced back above $60 a barrel after Russia said it would continue cooperating with OPEC to manage the cost of crude higher after its recent slump. The price of Brent crude has fallen in the past couple of months from a high of $86 to under $60 as rising supply has collided with fading demand to create a glut of oil in storage. Key to that supply overshoot has been Saudi Arabia's willingness to go along with demands from the US that it should boost output to offset the expected loss of supply after the reimposition of sanctions on Iran. The US president's support for the country's leaders in the wake of the Khashoggi murder in Turkey heaped even more pressure on Saudi to keep pumping when it would have preferred to cut its production. This week, the OPEC producers and Russia get together in Vienna for a key meeting at which Saudi Arabia and Russia are expected to agree to rein in production. Brent crude rose nearly 5% on Monday morning to its highest level in 10 days. So OPEC still matters, although probably less than it did in the past, when the cartel had the power to hold the world to ransom by unilaterally hiking the price of oil. The growing importance of US shale production has reduced OPEC's power, and this week it also lost a key member after Qatar said it would be leaving the group next year. The country has fallen out with its neighbours, including Saudi Arabia, after 4 Arab states imposed trade and travel embargoes on the country over allegations that it supports terrorism. Qatar is the world's largest exporter of natural gas, although a relatively small player in oil. Now, on the home front, attention is pretty much exclusively on the final acrimonious debates over Brexit. Next Tuesday sees Parliament voting on Prime Minister Theresa May's unloved deal with the EU, which both Remainers and Leavers hate. It currently looks extremely unlikely that MPs will approve the proposed deal, at least at the first time of asking, and that threatens a wide range of equally undesirable outcomes. In the meantime, the government is coming under heavy pressure to publish its legal advice on Brexit, which it's refusing to do, provoking accusations that it's in contempt of Parliament. What seems certain if the vote goes against the Prime Minister is that the Labour Party will trigger a vote of no confidence in the government. Much less certain is where this might lead. The fixed term of parliaments these days makes it very difficult to unseat a government outside of the usual timetable, so a general election to resolve the Brexit issue looks quite unlikely. What is looking increasingly possible is that the Labour Party, having pushed for and failed to get an election, will swing behind calls for a second referendum, which would probably include various options, including abandoning Brexit altogether and staying in the EU. Whatever happens, next week is going to be a historic period of political turmoil in the UK, and events will probably unfold extremely quickly. How markets respond to all of this is very unpredictable. Signs that Britain was heading towards a no-deal exit would probably see the pound fall sharply, taking the stock market with it. Movement towards a second referendum or even a Norway-style deal that sees Britain seeking a very close relationship with Europe, although nominally out of the EU, would most likely be welcomed. Across the Atlantic, in a further sign that the Federal Reserve's monetary tightening programme is running out of momentum, a senior Fed official has urged the central bank to be very patient as it considers whether to raise interest rates again in 2 weeks' time. Robert Kaplan, head of the Dallas Fed, said he wants to avoid a situation where the Fed raises rates too far, too fast and triggers an unnecessary recession. Last week, Fed Chair Jay Powell hinted that the steady pace of rate rises may soon come to an end. He said that US interest rates were approaching the neutral level at which policy neither constrains nor stimulates the economy. That was a major change of tack because just a month earlier he'd said that rates were a long way off that neutral rate. The Fed is under no obligation to take notice of stock market turbulence except to the extent that it feeds through into real economic activity. But clearly the central bank has noticed October's market volatility and is becoming more cautious than its previous suggestions of quarterly rate rises throughout next year would suggest. Friday sees the usual monthly non-farm payrolls employment report, which will be one of the last pieces of data to guide the Fed's decision on the 18th of December. The market turbulence in October and November has left many asset classes in negative territory for the year to date. This kind of across-the-board fall in markets is unusual because usually a diversified portfolio enjoys some areas of strength even in a generally difficult year. 2018 looks like being the exception that proves the rule, with almost everything in the red or delivering very low returns, and investors are struggling to find a port in the storm. One asset class that's currently flashing red lights is corporate credit, which has had one of its worst years since the financial crisis. Both investment grade and high yield bonds are in negative territory for the year on a total return basis. On one level, this is not a surprise. As government bond yields rise, so too will those on the bonds issued by companies, because investors demand a premium to compensate them for the extra risk that a company will go bust. In addition, as the economic cycle matures, the size of that premium, known as the spread, tends to widen because investors worry that the higher debts taken on in the good times will lead to higher levels of default in the near future. That's the nasty cocktail of factors corporate bond investors face today, and what is worrying investors more generally is the fact that the corporate bond market can act as a kind of canary in the coal mine. Investors often try to exit the credit market first and then move on to shares soon after. It's not a given that this is how things will pan out this time, but the corporate bond market will definitely be worth watching closely in the weeks and months ahead.